7. Now, the opening was the third worst for a mega IPO since 2008. The process of picking an opening price took a little bit less than 3 hours. Now, remember, Peloton, of course, still unprofitable. CEO John Foley told Bloomberg that the concern Peloton is losing money is, quote, semantics. To discuss, I'm joined by Techonomy founder David Kirkpatrick, and here with me in San Francisco, Joe Voboril of Farvahar Partners.
Hi.
So, Joe, you're here. Let me start with you.
Sure.
What happened today with Peloton?
Well, I think what you're seeing is a reflection of a complete structural change in the way the IPO market works, and Peloton is as good an example of any of the IPOs we've seen over the last 6 months, in that what we're really seeing is a story about demand and access and how that's changed in very recently as a result of a very active late-stage private security market, which is happening in Peloton's case 13 months earlier, where you saw entities like Wellington and Fidelity and Tiger Global and Balyasny, two of the biggest hedge funds in the world, two of the biggest mutual funds in the world. They bought Peloton for $14.50 a share. Peloton raised $550 million. That was 13 months ago. So as a result of that, 4 entities that were historically big buyers of IPOs, not only have they already bought what they wanted to buy, they might even be sellers at this point. And as a result, the IPOs, and you can look at Peloton and we can walk all the way back over the last 6 months, that is a new dynamic.
David, what are your thoughts on valuation?
Well, you know, the question of what is and is not a tech company gets more interesting by the day for me. And, you know, I heard your interview with the CEO of Peloton earlier, and he was saying software is their biggest investment, and that he basically wants us to think of them as a tech company. But, you know, in reality, you could increasingly say the same thing about CBS or Disney or so many companies, Walmart. Just because a company uses a lot of software and has an app or has a screen, it doesn't mean that they're a tech company. I mean, this is basically a company that sells exercise equipment that's being given an $8 billion valuation. I think that's illogical.
Gene Munster over at Loop Ventures spoke with me earlier this week, and he said he was really reassured by the fact that the IPO and the filing, Peloton was so transparent in their numbers relative to another company like WeWork, which we'll put on the back burner for now, which maybe wasn't as forthcoming with their numbers. Are you relieved at the amount of financial transparency that we got with Peloton?
Sure. I think that, to take a step back on Peloton, it's more like a $9.5 billion valuation at today's price if you take into account the 60 million shares that are options that are deep in the money. So it's actually, I would say, a very nice valuation for a business with $1.4 billion in sales. And I do think the market is ascribing a certain level of value to the subscription nature of the business, which is very high margin business. And if we want to call it technology, then we can. We almost have to call anything today a technology component. But what does it mean with respect to the transparency? If you want to buy Peloton, you want to make a bet that they are going to grow their user base, that they are going to have very low churn, and that they are going to generate a lot of cash flow. And that's an assessment that the investor has to make. But that's a very different question of, are they a tech company or are they not a tech company? It's purely a matter of how much money they're going to make in the future.
David, as we talk about financial transparency, I have to bring up WeWork. What's the biggest concern, the financials or the valuation at this point?
Well, they're sort of inextricably connected. Because if the financials were better, we wouldn't be so concerned about the valuation. I'm going to be impressed if they pull off an IPO before the end of the year at all. It doesn't seem likely. It's unclear what these new co-CEOs actually intend in terms of going public at this point. But I think WeWork is a shaky proposition as a business. And if I could just go back to what Joe was saying about Peloton, you know, whether or not Peloton's a tech company, and of course revenue from subscriptions is all fine and good, but it also has an element of faddishness, and it's a fashion business in a certain sense. Of course, you make some investment in this equipment, but you know, these things come and go as substitutes arise in the marketplace. So again, a $9.5 billion valuation. I was wrong. I thought 8 was too much, but it's 9.5. It really makes me question the rationale for an investor to buy it at this price. You know, let's see whether they can actually make a real business out of it before we start throwing our money at these people.
Well, David, you mentioned that you would be surprised if there was an IPO this year. We have heard that if they don't, they do need to start looking for cash.
I know.
Where do they turn for next for cash?
Well, there was a fascinating article in the Wall Street Journal about, you know, Jamie Dimon's relationship with Adam Neumann, and, you know, clearly they got a lot of support over there. You know, I really don't know. Maybe they'll get it directly from MBS and the Saudis. It seems like at the moment the reputation of WeWork is so poor that it's going to be a rare capital holding institution that's willing to give them very much.
Joe, your reaction?
I would just say that I think despite the salacious headlines about WeWork, they do have some assets, and I think the same Wall Street Journal article referred to what some of them can be. It strikes me that there are some parts of this business that people would be interested in. I can't say much more than that, just that I think that while we can focus on salacious headlines, there's actually some aspects of that business that are doing quite well.
Well, I learned a lot from this roundtable from both sides. Joe Voboril of Farvahar, thank you for joining me, and Techonomy founder David Kirkpatrick, you will be sticking with me.